So, top of the morning, everyone. It's Saturday morning, unusual, right? But the reason for the anticipation actually lays in the background you see. So, basically, just a little of a side story there. If it was for my girlfriend, Christmas would come usually at the end of August because she fucking loves Christmas. So, we just got to the point where we were starting to take down the Halloween decorations around the house. And starting the second week of November, we gotta get ready for Christmas. So we already decorated a good chunk of the house. But turns out that tomorrow, Sunday morning, Sunday afternoon, we need to keep on decorating shit out. And then we need to go out for Christmas shopping and whatnot. We like to be early. At least she likes that. So, you know, that's the reason why I'm recording on a Saturday morning instead of a Sunday. And that's the reason for the background because, I got three monitors and turns out they need to follow along with the rest of the decorations in the house. So that's it. Now, with that out of the way, let's dive in what happened in markets this week with the weekly market recap. Now, start out with the economic calendar as usual. You remember we were kind of waiting for the governor, the chairman of the BOJ, to come up and speak. Well, it turns out it wasn't that big of a deal. It was kind of a nothing burger. It was basically a copy paste of what you know traditional power speeches are. We are data dependent. We see this, we see that, we see improvements here. So we might move, but we are gonna look at the numbers first. So we retain the optionality of doing X, Y, Z. So a lot of words, but no real indication on what might be the Japanese central bank monetary policy, especially the decisions on rates uh, down the road in December. So again, nothing happened there basically. We had a few other data coming out, like there was a little bit of a resurgence in inflation. If you look at Canada, for instance, the CPI, it was negative the previous print, and it came back up positive. But just it might be just ebbs and flows at the end of it. And even if you look at Great Britain, they got 1.7, and at this time around it came in at 2.3. So you know it is just a little bit of an ebb and flow. If you remember, a few weeks back, we were looking at France and Germany, just to say in Europe, and they had massive negative prints. So, yeah, these things they can move up and around, but what you really care of is the trend overall, right? Now, we got unemployment claims in the US, of course, as every given Thursday, pretty much in line. I mean, there's not a huge variation in here. The Philly Fed Manufacturing Index actually came in negative compared to the previous one, which was particularly positive. Let's have a look at the chart. Yeah, it's still hovering around the zero line. I mean, it's not good, but it's not really bad as it was, let's say, in the middle of 2023. So, what you're gonna make of it, right? We got what? PMI in Europe, like Germany and France, it came in a little bit weaker than expected and still in contractionary territory. So again, it's no surprise if you look at Germany GDP, for instance, that has been negative for in ages now, and they are clearly in a recession, and they're dragging down all of Europe into a recession, most likely. So that's just the normal course of things right now. We got PMI in the US as well, though it was just a flash, so kind of in line with expectations overall. There's maybe a bit lower, but not really like by a lot. So nothing really incredible this week as for the data points. Michigan consumer sentiment coming in a bit lower compared to the previous print, but overall, if you look at the trend, it is still kind of stable, I'd say. We might talk a little bit more about consumer confidence later on. So that's it for now. Let's have a look at the charts instead. Now, again, if we look at the major currencies we usually follow, we see that we got that continuation in the DXY to the upside. It broke out of that infamous macro range, retested kinda, bumming ahead a little bit of a pullback, and then it just went higher. And conversely, of course, the Euro USD cross went lower. Um, Same for the pound sterling. Now we were looking at the Japanese yen against the US dollar because we got that press conference from Ueda coming out on Monday. Well, nothing really. I mean, we were at support. We got a little bit of a bounce closing down the week last Friday, and we just drew back this bounce. So overall, it's still coming down. As for the rest, and the DXY is still strong. Zoom out a little bit. Yeah. All right, the euro. It's really getting down to it, right? I remember I was looking at these lows right in here, but I wasn't expecting it to come in here like in 1, 2 weeks. But you know, at this current pace, it might be that we reach into it sooner rather than later. Who knows? But timing these stuff is always difficult. So just be aware of it. Now let's have a look at gold. Gold had a massive bounce, and I honestly didn't see it coming. I mean, I was particularly kind of confident that we would have held the support right in here, but I wasn't expecting such a strong bounce to be quite honest. My bet was on a little bit of a consolidation. It would have been okay to retest this level, but just breaking through like I mean it's powerful gold, I guess. Still, we did reclaim a few levels like this one and this one. Now we got this one. If we can get back in the previous range, the previous apex, we'll see what happens. Now the case might be if it is bearish, it's gonna retest it and keep on collapsing down, and then we'll see. Or we might reclaim it, holding it, right? And then trying for a new push higher. Who knows, right? What what's strange? I mean, it's counterintuitive to some degree, but if you check the the path ahead, the correlation that we have seen in gold and US equities and the strength of the DXY, it's like everything, I think everything is driven by the dollar strength. Right, so the dollar is basically crashing all the other currencies, and therefore people try to hedge their FX risk either by buying gold, which is of course overperforming even the dollar, or what you do, well, you buy US assets like US equities, for instance. So that that was always the case. I mean, that was always the underlying premise of the notorious milkshake theory. So we are seeing it playing out. To be fair, how long is gonna keep on going ahead? We don't know. We might have a sudden break or a sudden collapse, although it might be temporary, of the system and everything kind of reset. But at a current moment in time, that's the framework we are operating it. So we need to be aware of it. Let's have a look at oil again. Beachy oil, you remember I said I think the overall direction is still on the downside, but just pay attention being short this market because it tends to squeeze up a lot. So another example of that dynamic at play. Plus, with what we got coming out of Ukraine this week, I guess the geopolitical premium uh, was increased, although not massively. But I mean, it's not like if you would have an outrageous type of spread out conflict in the Middle East, right? But you know, when you got these geopolitical tensions in between superpowers, like in this case Russia and yeah, it's not really Ukraine, right? We at this point you should know that, right? It's basically Russia against the West, mainly the US, with all these proxy wars and whatnot. So I don't know. I mean, I'm not a geopolitical expert. I'm just a common bloke, but I think it was a little bit strange, right, to see the this move from the US administration authorizing the use of these ballistic missiles with a long range type of capabilities to strike back a little bit deeper into Russian territory. And they, of course, they responded by updating the nuclear doctrine or guidelines, saying that now they retain the optionality of striking against not only Ukraine, but even nations which are providing military aid to Ukraine, so namely the NATO countries, right? I was just like, I don't know. I mean, the old man it's just stepping out of office in 2 months. Why would you exacerbate the problem? Oh, right, just to throw a branch in the wheel of the next administration, probably. Or maybe to just say, you know what, we gave Ukraine everything they wanted, even the ballistic long-range missiles, and they can't win this war because at the end of it, they don't have the men, they don't have the soldiers to win it. So, a lot of political bullshit. I'm not gonna get into it much further, but just again, just bear in mind that depending what comes out, it could impact the price of oil. Although I would be more concerned if something like it would come out of the Middle East. To be fair, uh, let's take it for what it is. It's still ranging at this level. It's looking still it's looking heavy, but it's not cracking down. So the range is the range until the end of the range, I guess. You can just go short range high, go long range low, right? Although, right, it's easy in hindsight, but that's what you gotta roll with if you're trading oil. Let's have a look at Bitcoin. We finally hit, did it? Did it hit? Pretty close on spot if you look at Binance. But I think the CME futures, they actually hit the big figure at 100K. Let me check. Yeah, we did on CME futures. Of course, there is a little bit of a premium on the futures. Why not? Um, well, again, getting back to last week, it was bullish. It was kind of consolidating at a higher level and it was kind of reaccumulating. So, all in all, this move up was a little bit uh, in the cards. And then we this week we got the introduction of uh, options trading on the IBIT ETF. So again, if you're not familiar with options, not that I'm not a master, an options master, but I know a thing or two. But basically, when they went live, you got a lot of imbalance in between the calls that were purchased against the puts. So what happens is if there is a huge quantity, a huge amount of people buying calls, they're going to have upside exposure. And the market maker, which is selling you the calls, which is providing the liquidity in that market, eh, is going to need to hedge himself against the possibility that your trade actually plays out. And since he's taking the other side of it to allow you to build up the position in the first place, the market maker will need to hedge himself. How does he do it? Well, he basically buy the underlying. In that case, Bitcoin. It could be spot Bitcoin, it could be futures, just something which gives him exposure to the upside, same as you do, so he can hedge the other part of the transaction and being delta neutral. I mean, if it wasn't like this, otherwise you would see a lot of market makers going bust and out of business, and you wouldn't have a market anymore because there wouldn't be any other liquidity provider, right? So that's it. Which uh, opens up the floodgates for potential gamma squeezes in the future, like what we've seen with GameStop stocks. If you remember back then, it was a little bit of a different dynamic because, of course, in order to tame that type of a spike in volatility with GameStop, the company can always issue more stocks, right? But you can't issue more Bitcoin because the supply is just, it's already regulated by the rules of the code, right? So to speak, using just, you know, uneducated type of words, right? It would be too long to go into all the mechanisms there, but just be aware that with these options, you might have basically a little bit more of increased volatility just by the nature of them. And if you check like the options table charts and you look at the different strike prices, expirations, and implied volatility values, what you see that basically there is a huge amount of volatility which is implied in those options. So it's gonna be something else that you need to pay attention to if you are involved in these asset class. So again, just be aware of it. Now, there would be only just one more thing. And again, I know it, I'm probably gonna attract all the hate from the Bitcoiners community, but to some degree, everything is good for Bitcoin. The more instruments you add on top of it, the more it gets legitimacy in the eyes of the global financial world, right? But at the same time, I think it's kind of losing its main proposition, which was being an alternative type of a monetary system or currency. Why do I say that? Because I mean, if it keeps on going higher in price, but that just incentivizes people to hold it and not spending it, while you would need to spend a currency to actually use it. Now you might say, yeah, but you see these third world countries that are actually starting to implement it as a real transaction mechanism. Yeah, like El Salvador was a prime example of that. It, and I get it. I mean, for them it might work. It could work even for people in Argentina, I guess. But people in Argentina, they decided with Milei especially, he claimed that he wants to dollarize Argentina instead of Bitcoinize Argentina. So I guess it's going to be a fantastic asset to speculate on, to invest on, but as a currency, I don't see it yet. So if that was the main proposition of Bitcoin, I guess no, it's it's not gonna solve the problem of medium of exchange. It might solve the problem of store of value though. So if you do like hard money, that might be your main demand from something like this. So you should be cool once again. Just a thought, I don't have anything against it at the very core. I'm just, sometimes it's strange. You talk to people and they're like, this is the new money, this is the money of the future. And it snowballs from there because then you ask, what is money? And they don't know. Honestly, they don't know. It's not a capital sin. Nobody knows. Not even Jerome Powell knows what money is. If you check the transcript of different FOMC meetings throughout the last decades, comes out that they don't know how to define money and they are supposed to be the supreme monetary authority. So if they don't know, how can you? It's all good. It's just as usual, everything gets back to a lot of different narratives and ultimately what you choose to believe in. We no real answers or evidences or whatever, just because you think it is like this. Because I like it, right? Because I like this narrative. So it's gotta be it. Yeah. Anyway, moving on. Let's have a look at the yields on the US Treasuries. They've been particularly stable this week. Still grinding higher, to be fair. So the I guess the other narrative about inflation recognition, the Trump trade, it's still up. It's still up and running. Um, and conversely, sure, the bonds should be down. Well, yeah, they're still relatively down, but At least they are stabilizing a little bit. They didn't really collapse this week as well. Although, yeah, if you want to build up a long position in this, I would really wait for some sort of a confirmation from the charts, of course, but also from the economic data and the macro data, right? I guess, in the short term, all that comes out from yields and bonds, it's just a matter of positioning. But if you stretch the time frame out and you start to look at it in terms of weeks and months, fundamentals, I think they take precedence over everything. So it's macro. It plays out over months, so you just need to be patient and wait. Mm, I guess, getting back to particular spoken out topic these days, everything is, it seems everything is revolving around coming, the incoming Trump's policies, right? So, especially tariffs. Everyone is talking about tariffs, tariffs this, tariffs that. And with tariffs, we're going to have inflation. And then I went over these. There was a video I recorded like 2 or 3 weeks ago talking about Trump and how I saw a lot of controversy and contradictions in between the policies he's talking about and the final goals he would have for the economy as a whole. And I was worried too, like, you know, gotta be, gotta call it spade to spade. I was a bit worried. More precisely, I was like, you want to fight inflation, but you are going to implement XYZ, which might have an inflationary type of a push. So how does it work? Now, if you start to give it a bit more of a thought, you can come up with something like this. I'm gonna share it right here, right now, just to let's see. So this should be a little bit of what it's concerning people right here, right now, about the potential inflationary push that we might get from tariffs. But this is a little bit of a breakdown of what could happen if you really implement these tariffs, right? And I'm not gonna read it. I mean, you can read it. Just pause the video and read it. But basically, what happens is, as soon as you implement a new type of a policy, the participants in markets, in the real economy, they tend to react to it. So, just because you implement X, it doesn't mean that you are gonna mathematically have the Y response. Or at least it might be that you get that type of reaction in one sector, but overall, the economy as a whole tend to keep on maintaining its current status quo because you just shift things around. So you might have an inflationary push in one sector of the economy or for one specific good category, but you have the opposite reaction in the others. Like in here, they talk about the substitution effect, right? Or, if you, I assume at this point you already read that. So let's move along. Or what you might get is, of course, the reaction from business owners or from other participants in the global economy. All right. So just have a read. I mean, it is just common sense, or at least it's a critical point of view, right? It's what I do like. It's not taking something at face value just because you read it. I mean, if it's on Twitter, it's got to be good, right? Especially if that account is publishing it, because I do really like that account and I like that guy. So if I like him, he must speak the truth, no matter what, right? Well, turns out more often than not, doesn't work like that. And there is also a little bit of an historical example right in here with a little bit of a chart below it. So it might be a little bit of a food for thought, right? Now, again, you see what happens when you implement tariff and you got these surveys from civic science, I guess, and that's what happens, or what could, let's say, could happen if you implement some sort of a tariff system which for some reason creates an inflationary spike in some goods or some sectors of the economy. So look what happens. It's not like you see, if you look at the spectrum, the majority of people are not saying I'm gonna finance my purchases, but they say I'm gonna shop for a different thing or for a different retailer, or I'm gonna wait that for saving, right? If I'm gonna wait, if I'm not spending, or if I'm looking for something cheaper, some sort of a substitution, that means that the inflation which is causing that A branch of the economy, it's gonna be offset by the deflation you're gonna see in the B branch of the economy. So again, um, if you categorize inflation as for the CPI, just be aware that the CPI is an index, and the index can be changed based on consumer behavior. So you can basically change the way different stuff are factoring into the index because you see the consumer behavior is shifting. All right. So again, just be aware of it. Now, if you remember, and if you look back, just to have a little bit of a background, if you look back at the first Trump term, he implemented a bit of tariffs already. I mean, not to the magnitude he's talking right now, but he implemented a bit of tariffs back then. And guess what? The following Biden administration, he didn't take them away. He maintained them. So and if you look at it, it looks like throughout his presidency, from what, 2016, basically when he took office, and you look at the inflation rate and the 10-year treasury rate, it was particularly stable. Then, of course, you got the pandemic in 2020 and everything collapsed. But 3 years and you didn't have a lot of inflation, did you? So again, it's always useful to look at what happened throughout history, especially recent history, to then trying to grasp what might come later on, right? Now, let's move to equities, indices, and whatnot. I changed the layout a little bit. These are futures, but I wanted to use the same layout I use for the ETFs just to look at what the four major indices were dealing with. And basically, if you remember, we were talking about a potential additional push to the downside, like we've seen in the Nasdaq in here. But overall, if you were looking and checking the moving averages, this pullback was, in the grand scheme of things, it was a healthy pullback. We just drew back a little bit of the up move after the election extravaganza in every single one of these assets, basically. And we reaccumulated around the 21 exponential on the daily. And guess what? We ended up the week with a little bit of strength, especially in the Dow and the small caps, right? Which is another thing which should point to the fact that these quote unquote Trump trade, it's still in play to some degree. While you see a little bit of a stutter step in the, especially in the Nasdaq. The S&P overall is reacting particularly good at this junction right here. Now, why the Nasdaq might be underperforming, so to speak, again this week? Again, I mean, if you think about the Trump trade, that should ideally, right, conceptually, benefit domestic US manufacturing and industrial production, which is why you're now seeing a bit more of exuberance in the Dow and, of course, the small caps. While I guess there was a bit of worrying on the tech sector because you do know that all the, especially the chips industry, revolves around imports. So, if you start to have some sort of a trade war, it might be that those materials or raw materials you need, it's gonna be a bit more expensive to get. Like, if something is manufactured outside, it might be designed in the US, right? The projects, the engineering behind it. But then if you need to actually manufacture it abroad because it, you know, cost of labor is cheaper and whatnot, So then when you import it back into the US, you might have a little bit of a premium to pay on top of it. So could this be? I I honestly don't think overall this whole problem with tariffs and potential inflation will really get to a point where it's just becoming something which is running away out of control. It's not spiraling out of control in my view. Because I think at the end of it, and it might be just a guess, but I think Trump himself, he doesn't want to impose tariffs. It is just a negotiation type of a tool, right? Uh, because I mean, if you know it, if I know it, if everyone is talking about it, right? If you implement these measures like this, it's going to be inflationary tomorrow morning, all right? But you know, the point might be, yeah, that's what you think, and it's going to be inflationary for us in the US, but it's going to be a massive cut on demand from the US toward the outside world. So we know it, but the outside world knows that if we do this, they're going to see their income, revenues, GDP growth going down. So it's a little bit of a threat, right? And I guess the threat of implementing these tariffs is what he's really aiming at. Like, you know, if I come at you and I say, look, I'm stepping into office January, what was it, 15, 20, well, let's say middle of January next year. The second I step in, I make a press conference and I say, look, I'm targeting, let's say, China or Europe or this and that. 2 years from now, I'm gonna implement a 60% tariffs on you, and it might go up to 80, 100% if you respond with XYZ. Now, the problem is not that you're gonna implement it, but that you say that you're gonna implement it in 2 years. What do you think companies and businesses are gonna do? They're gonna front run it. If they know they got 2 years, they're gonna try to, bring back the manufacturers they have, let's say in China, for instance, and bringing them back into the US. Because at that point, the cost benefits type of analysis will shift. Now, it is true, on one hand, they might have to face a bit more of an expensive labor cost, but they will still have access to the biggest consumer market in the world, which, they don't have anywhere else. There's no point in producing stuff for cheap if then you don't have anyone to sell them to. Chinese internal consumption, it's not that big of a deal. And although with the recent stimulus and policies, the Chinese government is trying to spark domestic consumption, it's not really working, right? So just it is an interesting point of view in my opinion. And who knows? In the grand scheme of things, it might be what the Orange Man is really aiming at. Who knows? Again, it's still developing itself. It's not yet in office, so we need to wait and see what's going to happen when he actually steps in. But as a mental exercise, I think it's nice. All right. So with that out of the way, let's just look at these indices. And again, overall, they are grinding higher. We were anticipating, especially coming into next week. Remember, it's holiday short week. It's gonna be Thanksgiving, so expect a little bit of lighter volumes, right? And after that, we might see a bit of a surge. Like for instance, I do remember I had some sort of a screenshot for it. If I can pull it back, but I think no, I still got it. So this is a little bit of seasonality type of analysis on November, which again, a huge data set from the 50s. So you see that November is usually like this. And turns out today is what? 23rd. So starting 24, 25, right? So basically depends, I guess it depends on when Thanksgiving actually falls. But by the end of the month, we should see a little bit of a pickup in the volumes and potentially the buying pressure in the in all the indices. So that should be the bullish case, all right? If you want to have it. Um, what else? I think Oh, there was a piece of news which came out this week, and I was it was particularly intriguing to me. Now, basically, you might be familiar with the name, we might not. It's Dr. Edward or Ed Yardini, which is an economist. Is I don't want to say he's famous, but it's known in the FinTwit community. It's not someone which came out of nowhere. He is massively bullish. He's actually revising targets higher for the S&P. He's now talking about the S&P hitting uh, 6,100 for the end of the year, and it should go up to 10,000 for 2029. And it's not only that, but the pace at which he's forecasting this up move is that basically, you know, he said it should go up to, let's say, 7,000 by the end of 2025, 8,000 by 2026. So, at this rate of change, which if you start to really dig into it, you know, final target 10,000 by 2029, 30, basically. If you consider, let's say, if you zoom out a little bit, right? If you consider the trajectory of these asset classes, starting from the peak, well, the trough, should I say, of the 2009 bear market, right? Basically, this one right here for all of them. If you project that type of a target, that should be equal to what? A little bit of a mental math. Um, a bit more than 7% rate of return from here to the end of the decade, which, I mean, it's not that big of a deal in the end, right? We have seen the stock market returning more than 20% year over year over the last 2 years alone. So, I mean, it sounds crazy, it sounds all cool and fancy, but 7% average rate of return year over year, it's gonna suck. Really, it's gonna suck because you're now used to have 20% plus. So, there should also be another problem with this forecast by Yardini. Well, first of all, is that, forecasting stuff so far down into the future always exposes you to the risk of error because a much bigger time span, much more variables, much more factors to be considered, much more things could go wrong over the longer time span, right? So it's already hard to keep up with those expectations. A little bit like Paul Tudor Jones, right? Yardini already made that sort of claims, and it, you know it was back in 1999 and 2007. So uh, I remember I just read online. So you know, we assume, let's just say we assume it's it's fact, right? He actually said that, right? So he made this bullish forecast that in the end they just failed. Like at the end of the 90s, he predicted the S&P to reach into 5,000, and it didn't happen because we got the dot-com crash, right? Then we got the 2008 crash a few years down the road, which basically confirmed that type of a lost decade. So you know, before actually reaching into 5,000, there was a lot of time in between the figure to be actually hit and the forecasts he has. So again, just basically that was that period, right? He forecasted the S&P to reach into 5K, and then we got these. Then in 2007, he said, "Yeah, well, it didn't go first time. It's gonna go this time." No, we got another type of a double dip recession in this decade. So always be careful with forecasts because it's very easy to be misled by them, right? And at the end of it, that's the problem when you start to talk about animal spirit, right? For those which don't know, I guess everyone should kind of know what animal spirit is, but that's basically optimism, that confidence that investors and consumers might have about the economy, about markets, and therefore they are brought up to take emotional decisions based on optimism alone. And it's all cool up until it lasts, but then there is a point where it doesn't last, or at least it ends. Right? We could look at this, for instance, like if you look at the confidence composite against the actual price of the S&P, you basically see that when you know the confidence index is particularly high, you see the market tends to go up. When the confidence comes down, the market comes down. So it's all based on some sort of a fugazi, just expectations. They tend to lift the market higher up until the point expectations are not met, and at that point everything reprices down to where it should be. And according to standard deviations, fair value, price to earnings, earnings per share, all that type of fundamental analysis, right? Now, it is true that when you talk about animal spirit, there is a nice link in between that and QE. So basically, what was done after 2008, starting with Bernanke, right? And all the debate around financial easing, quantitative easing, if you read the transcripts from Bernanke himself, he said black and white that all these intervention from the central bank, it was mostly to boost consumer confidence and therefore spark animal spirit. They knew from the start, they knew that no matter the amount of reserves they would have quote unquote printed and reserved. So there's no money involved, right? No matter what, if the consumers didn't want to spend, if the banks didn't want to uh, enlarge their balance sheets and grant issuing credit, there wouldn't have been any type of economic type of a renaissance, so to speak. So everything was revolving around playing with consumer confidence and bring them to spend. And at the same time, if they're spending, banks become optimistic and they start back to extend loans and creating money, lending out money into existence, and the economic machine starts back again. So that was it. The problem with QE to some degree is that although it was particularly good for asset prices inflation, if you check, it wasn't particularly good for what it's really driving the real economy. Now, here's a comparison, and you can see the increase in the Fed balance sheet, so therefore QE, because QE is purchasing of assets by the central bank. So those assets end up on the central bank balance sheet. And you see the corresponding result, saying wages and full-time employment and corporate profits and GDP. So, the amount of intervention in percentage term compared to the net percentage result in this aspect of the real economy, it was particularly subdued. which brings us back down to the fact that the more you spend, the more debt you take on, the less economic growth you're going to have into the future. And that is a drag on future growth. So that could be one, right? Now, the sector where these type of interventions had the most effect was, of course, corporate profits. Corporate profits actually went really high, right? If you look at these from 2010, basically after the great financial crisis. Now, the thing is that if you think about companies, they have been able to push these profit margins and actually expanding them because, of course, they took advantage of supply constraints after, especially after the COVID pandemic, as you can see in here in 2020. So they were able to raise the prices and pass it on to consumers. And they, of course, took advantage of the huge fiscal policies implemented by the government. So they are having a laugh at this moment in time. And as you can see, their percentage, well, the impact as a percentage of GDP were actually skyrocketing. And it still is. I mean, if you look at Nvidia, it's growing revenues and earnings like that's really crazy shit. Again, at a point it will come to an end, but for now, I mean, everyone is calling for the AI bubble. But this is not like 2000 or 1999. Back then, you got companies which are weren't actually growing earnings and making money. Nvidia is actually making money up until the point it does. Although you might say it's going to be hard going ahead to maintain and to be faithful to those expectations, but up until it does, you might even say that if you look at the price to earnings ratio for Nvidia, it might be priced particularly fairly, right? It's growing earnings like you've never seen in history. So again, up until the point it lasts, I wouldn't call for an AI bubble, right? Just as an aside. Um, the the whole thing with it is that what we've done is we have borrowed from the future to fuel current growth. But you know, it's a little bit of a problem because, yeah, I mean, the S&P went up for sure, and it basically returned what 300%, I would guess. Yeah, 302. But if you look at measures like the cumulative real GDP or cumulative S&P sales growth, well, they didn't they didn't go up as much. So everything is artificial at a point. And that it's a manifestation of the huge disconnect that you have between financial assets and financial markets and the real economy. So at a point, these have to come to an end, and someone is already paying the price for it, right? I wonder who might be, right? That's another thing that companies manage to really capitalize on, which is technological advance and progress, right? Technology seek efficiency. Efficiency is good because it brings down your cost of production, your costs of execution, and therefore it raises your profit margins per input, right? It's just basic economics, right? But although we might have had all these huge technological advances and progress, the point would be that throughout the same period, what you have seen is basically this. If you look at the employment, it's way below trend. So at the end of it, the ones which are paying for this are the average Joes and Janes. And these charts, they just speak for themselves. So again, like even in this case, right? That's basically taking into consideration the adoption of the internet, and then you got the revolution of smartphones, tablets, laptops, and the social media, right? And yeah, corporate profits are going up massively, but at the same time, if you look at the trend of the wages, it's massively going down in comparison. which creates at the end a bifurcated type of economy and therefore a society. Because, the elite is making a killing, but the rest of the plebs is actually not holding up particularly well compared to the rest. So, which is why then you end up having all these social crises, all these disconnection in the social tissue. So, would you like to say that's the big failure of capitalism? Well, I don't think so. I mean, because we are not living in a capitalistic system. It would be, let's say, if you see the government completely stepping out of the way and letting the free market doing what they need to do, and then you see these results, then I would say capitalism as a system has failed. But since you got government intervention pretty much every single day at this point, and it creates a massive amount of distortion and inefficiencies and malallocation, malinvestment, then I wouldn't say this is the failure of the capitalistic system. This is the failure of government intervention, if anything. So, that would be my take overall on it. Now, um, speaking of what might destroy this perfect castle of expectations or optimism and whatnot, let's have a look. Because, again, everyone was talking about recession. Recession is coming. Recession it didn't come. Right now, instead of listening to people on the internet and relying on your favorite podcast, one thing you might want to do is actually checking the charts because charts rarely lie, to be fair. So I usually look at the copper to gold ratio. It's a little bit hard to see. Let's see. On white might be easier. And if we zoom in. So, I mean, it's pretty self-explanatory. Copper to gold ratio is just the relative strength of gold against copper. So if the ratio goes down, gold is appreciating against copper. At least, you know, it's appreciating more against copper, or it's suffering in terms of price action, it's suffering less relative to copper. And the second chart below it shows you basically the relationship in here, right? You see that in the end, copper is particularly stable now, the orange line, but gold, it's going up so much that the ratio overall goes down. Now, that's just one ratio that usually, let's say if you check like 2008 was here, and then you see the ratio going down, that was a massive risk off, all right? And, it is something which worked particularly well, you know, if you really stretch that out back in time, all these periods where you got peaks in this ratio coincided with a bit of a downturn for the economy. Now, there is another ratio which might be interesting to look at, which is the gold to the S&P ratio. Now, the green shaded area, those are US recessions. So what you see is that basically you got these massive cycles, and those are basically the peaks and the troughs in it. It shows the process of capital flow shifting. What do I mean by it? Now, since again it is a ratio, if it's going up, it means that gold is appreciating more than the S&P, or it's holding up relatively better than the S&P. So, of course, you could get back, prior to the 70s, but I thought it doesn't really make a lot of sense because up until the 70s, gold was still pegged to the dollar. Uh, so I guess the old study really holds a little bit more truth if you start to compare it after we got the depeg, or the decoupling from the dollar after Nixon and the Bretton Woods was ended and whatnot. So you see that basically when you got a shift in this type of trend, you usually get a period where you might have a few recessions into it, but certainly being in stocks might not be the best place to be. All right. And when, of course, things revolved around, like in this case, it was at the end of the 70s and getting into the 80s, Yeah, I mean, you got one or two recessions into the throughout the 80s, like 82, I guess, and you got the crash of 87, 88, if I remember correctly. But overall, it was a good period for stocks. So up until the point you get to where 2000, the dot-com crash, and you see the ratio in between gold and uh, SPX in this case. You got the shift. It would be a shift, market structure break, whatever you. It's just a trend reversal at the end, which is marked by the dot-com bust and the dot-com recession. And throughout that period, starting in 2000, then you had another recession in 2008, of course, but up until the point the ratio goes up, if you get back to these, for instance, so let's figure this out. It was 2000 up until way basically 2011, let's say. All right, what you get? Well, 2000 was here, right, more or less, and 2011 was here, basically when we resumed the bull market. Same for uh, the triple Qs as well, right? 2000 dot-com bubble backs down, back goes back down, and then it's not up until 2011 that we start to get a sustained type of upside. So it might be an interesting ratio to look at. Mind you that just right now, as you can see, even recently, we got a break in this structure in 2020, end of 2019, beginning of 2020. So again, you might say it was the COVID pandemic. Yeah, wow, it was the COVID pandemic. But if you remember, I mean, at least in the US, lockdowns and whatnot, they didn't start up until February, March, but we were already breaking out in January. So I mean, a little bit of a preliminary warning sign, maybe. Who knows? But what about now? I mean, we broke this trend line. So what? If we retested it and we start to go back up, could this be the initial stage of a recession? Mind you, this is a monthly chart. So in order to get back to it, retesting it, and probably bouncing, it could be in 3 4 months from now. So don't panic. It's not there is no gonna be a recession announced tomorrow. It might be Q1 or the end of Q1 2025 if if it ever happens. But at least instead of waiting for the BLS or the NBER to say that it's a recession, you might look at something like this and having a little bit of a confirmation, which is based on market behavior instead of talking heads in television. Another thing which was nice to look at was the unemployment rate, because for a long time I've heard about people talking right, and they were like, yeah, unemployment, it's the last shoe to drop. Up until the point you don't see unemployment really going up, you can't say we got a recessionary warning. Well, it looks like every time unemployment basically has risen 15% or more to the current lows, we got a recession. Like in here, 15% recession, here, 15% recession, here, recession. I guess in here is a bit strange. I mean, we got two recessions which were very close together in the 80s. So, I mean, you could just copy paste this one to here and you would see that. Yeah, I mean, basically when you get to 15%, it's kind of like when the recession was declared. Although, they're always declared uh, in retrospect. So, you know, it might be possible. Let's take a random point. It might be possible that you get to this point, let's say right here, and the session is already over, right? You are here now, let's say August 2029, and they come up and say, yeah, oh, you know what? You remember back in beginning of 2008, just 1 year ago, 1 year and a half ago. Yeah, that's where the recession came in. Oh, thanks a lot, Captain Obvious. Didn't figure that out, right? But if you check these type of measures, it might be that you are going to be able to actually realize we are in a recessionary environment way ahead of officials coming up and telling you. Again, you can just backtest it for yourself. 15%, we are in recession. 15 recession. Even in COVID. Although, do you want to call it COVID an outlier? All right, let's go with it. But I mean, one, two, three, four, five, six, seven. Would you call it 7 out of 10 over the last 50 years? It's not bad as a statistical edge. And even here now, it looks like we are from the lows in unemployment, we are basically up more than 15%. Now, you might say unemployment is not that big of a deal, it's just 4%. Yeah, it's not a big of a deal, it's just 4%. Mind you, it wasn't that big of a deal, it was just 4.4 in 2008. And then from there, it just skyrocketed. So, again, it, those are the things you might keep in the back of your mind, highs. And sometimes, once a month, right? Since it's a monthly chart, you get back to it and you check it and you look and you try to pair it up with what is happening in the economy or with the stock market or with gold or with oil, whatever you want to look at and whatever you are interested as an investor or as a trader. And it might be good for a preliminary warning sign or to actually confirm what you think the data are suggesting you. All right. So again, overall, this is it for the week. The markets didn't particularly move a lot, except for oil, which had this massive uh, bounce, and of course, Bitcoin kept on going higher. But the rest, stocks were, as expected, flat to a bit higher. Gold was about to bounce, didn't expect this bounce so violent. All right. Currencies, they kept on moving in the anticipated direction, so nothing new here. There weren't a lot of surprises this week, so just take it for what it is, right? Now, next week, we're going to see what happens again. I told you a little bit of a light trading volume, at least that would be my expectation. And then we're going to have, of course, the Thanksgiving, and I guess at that point, it's going to be game off up until the first days of December, most likely. Um, with that, I'm gonna wish you, as usual, a good rest of your weekend. Considering it's Saturday today, a good weekend, I might say, because for you Yanks out there, you didn't even start Saturday yet. I would suppose, right? Yeah. So have a good weekend, and let's check what's coming up for next week. All right. And with that, be nice and be cool. Neil's out.